Hey everybody, welcome back to the channel. Today we're talking about the FOMC meeting that's happening tomorrow. And we need to talk about the FOMC meeting that's happening tomorrow because Jerome Powell, who's the chairman of the Fed, might just end up doing something that hurts the market. Now, in all likelihood, will he crash the market? Will he try to do something that's a little bit uneasy? You would want to lean no, and we're going to talk about why it's probably no. But in the past, what we've seen is that any sentence that he utters, any word that he utters, literally the market is just reacting to the little minutia of the things he says. It can trigger a stock market sell-off. Now, are these stock market sell-offs lasting forever? No, it's more like short-term trading if you're trying to play the words that he says. But essentially, the words he says does have a massive impact because as the chairman of the Fed, he has immense power over the direction of how the Federal Reserve is going to inflict monetary policy over the United States, whether they're going to pump more money in, whether they're going to take more money out. And as a result of that, the stock market has to take him seriously. It doesn't matter who the chairman of the Fed is, they are important. These meetings are a way for the stock market to gauge an understanding of what the government or the Federal Reserve, which is part of the government, but it is a apolitical institution. It's not supposed to be aligning itself with agendas, even though that doesn't always happen. It's supposed to be an institution that's looking at the money coming in, the supply chains, the inflation, the way stocks are being valued, the way cryptocurrencies, like it's supposed to look at everything holistically and come to a conclusion of what needs to be done. So what has happened over the past year? Well, we've had supply chain shortages based on the pandemic. That has led to people buying more things, which has led to the prices of more things going higher because there's less things in the stores for people to buy because of the supply chain shortages, which has led to more inflation. Additionally, the Fed has pumped in around $7 trillion of liquidity over the past 2 years in response to the COVID pandemic. Interest rates were near zero for a long time, even negative to one point, meaning it didn't cost anything to borrow money because the federal government wanted people to borrow more money, to start more businesses, to pay for more things, because that would stimulate the economy in a world in which March 2020 to June 2020, the economy was essentially shut down because of the pandemic. So we have had a 2-year cycle in which there's been so much artificial liquidity, artificial stimulus going into the economy because of how scared we were, because it was a global pandemic, something like that has never been have happened before, to the point where now it's catching up back up to us. We had an insane bull market. I mean, 2020, you could buy anything. It was going up. It's kind of the reason why a lot of the cryptocurrencies and NFTs really started getting more attention because people realized they can make serious money off of that stuff. And now stocks have fallen dramatically as a result of the things that have happened because valuations have come back to life. So the reason valuations have come back to life is because the Federal Reserve has decided that it's not going to allow inflation to continue. And as we can see in this article right here, if you don't want inflation to continue, you've got to raise interest rates. So Powell said in a panel discussion hosted by the IMF in April that the Federal Open Market Committee, the FOMC, and as the Fed's Monetary Policy Committee is known, was considering a 50 basis point or 0.5 percentage point rate hike in May. This means that if rates are 2.5 right now, they would go up to 3, right? 2.5 to 3. It's not 2.5 right now, but that's kind of how it would be. He said the central bank is committed to raising rates expeditiously, meaning if they want to raise rates because they are afraid they're not tackling inflation, the way to tackle inflation is make it harder for people to spend money or borrow money so that there's less money in the system that gives supply chains the time to catch up with inflation. And as a result, people stop spending money, so less money gets used, which means inflation goes down. The value of the dollar would increase, not decrease, because there's not that many dollars, because there's not that many people spending. This would be the first time in 22 years that the Fed raises benchmark rate by half a point. So that's why this meeting is such a big deal. This has not happened in the past 22 years where the Fed was like, all right, we're going to do it by half a point. Usually it's by 0.25 or less. He also said that a 50 basis point rate hike, not only in May, but potentially in the upcoming months, as well as preferred by several FOMC members, could happen. Now, why is this relevant before we get into quantitative tightening? Number one, when you raise rates, it really hurts valuations because companies, especially growth stocks, the Palanters of the world, the Pelotons of the world, all of these types of high technology companies, even, some larger technology companies like Google, Facebook, etc., they don't have to worry about this because they're big enough now. But high growth tech stocks that are unprofitable, that are going after market share, they need to usually borrow money. And the cost of borrowing money is determined by the federal interest rate. If that interest rate gets higher, then the cost of borrowing money is higher, which means future profits and cash flows are intrinsically lower because it costs more to get that money. And if stocks are only the present value of future cash flows, if it costs more to have those future cash flows because it costs more to borrow that money, then at that point the valuations of those companies have to compress, and that's what happens when the interest rates go up. Now, the federal government or the FOMC is saying, hey, we're going to do it by by 50 basis points. That's why we've seen valuations go down over the past couple of weeks, because the Fed is like, all right, or the market is like, all right, we're baking that in. If it does 0.75, which has been rumored, but it's probably not going to happen. But if it does, the market has not baked that in. That's going to go bad even more. The market is also annoyed because things are so bad right now in the market that they don't think we need to compress valuations even more. But the Fed has some different perspectives on that, and we'll talk about that in a second. Now, the Fed is also considering quantitative tightening. The last time the Fed reduced its balance sheet in 2017, 2019, it did so by $50 billion per month, meaning they're taking money outside of the market. They're selling bonds. They're not ingesting money into the market, which is quantitative easing. That's, putting more money into the stock market, putting more money into how people are trading and using that money. But now if they're selling it, that means that money's going out of the market. It's going out of stocks. It's going out of a bunch of different things, which means there's just less liquidity in the market. The Federal Reserve is expected to announce more details on how it will reduce its $9 trillion balance sheet, which again doubled in size during the pandemic. So they put in a lot of trillions of dollars in the pandemic, which is a much slower pace than the $95 billion the FOMC said it would consider this time. So they did $50 billion 3 years ago per month in terms of selling bonds and getting rid of liquidity from the market. Now they're considering to do $95 billion. Now, the funny thing about this is we have a really strong labor market. In a time like this, technically labor, we should be struggling. People should be struggling to find jobs. It shouldn't be that good. We have the exact opposite. So the labor market is currently near full employment, meaning that there are more job openings than people actively looking for employment in the U.S., which is also not the best because that means you have to pay more to get people to work, which means inflation goes up, right? Because wages go up, and that's not necessarily a good thing. U.S. employment costs jumped by 4.5% in the first quarter of 2022 versus a year earlier, the most in 2 decades, which means employers are paying more for employees because it's hard to find them because there's not that many people, which means the price goes up if the supply is lower and the demand is higher. Powell will no doubt be asked about how the Fed views the recent strength of the labor market, particularly in the context of wage and price pressures. He's likely to continue to extol the considerable momentum in the economy while reiterating that the degree of tightness in the labor market may be producing unhealthy imbalances that are driving some sort of momentum in inflation. The argument he's making there is that as of today, May 3rd, a record 4.5 million Americans quit their jobs in March, which means if all these people quit, they're trying to do their own thing, right? Or they're trying to do something that's outside of getting a wage, which means if you're a McDonald's, you need to pay, if you were paying $7 and now you're paying $20, I don't know, I'm making this up, but if you have to pay a dramatically more amount of money, even if it's 11, 12, $13, that means there's going to be more inflation because you are spending more for the same type of productivity, but you're not getting anything that's more productive. Additionally, if you just have to spend more money than you were spending before, the prices have to increase, right? That burger is not going to cost $4 anymore if you have to subsidize the cost to the consumer because the price of the burger has to go up in order to retain the profits of the company. So it's not necessarily the best thing in the world, but it's sort of it's interesting to think about from an economics perspective, because if these 4.5 million people all start their own businesses and these businesses start employing more people, then you might see more entrepreneurship that leads to more jobs and more opportunities. But it's hard to kind of see this because we've never had something like this happen before. The number of quits increased most significantly in the professional and business services sector as well as construction. The overall quits rate moved up 3%. As employers require workers to return to the offices, quits are ticking upwards. People don't want to go back to the office. Airbnb just said that everyone can stay home indefinitely. So Airbnb is kind of embracing that modern culture, but a lot of companies aren't. A major reason for quitting is to find a remote opportunity. The number of available jobs also rose, climbing to 11.5 million. So it's actually one of the best times to actually be able to get a job. And as you can see in this chart right here, job openings in the United States stood at 11.5 million in March, while job quits reached 4.5 million, both setting all-time highs. There's a lot of people not looking for a job, but there's a lot of people looking to hire people for a job. Interest rates likely are going to go up. Quantitative tightening is going to happen more. The Fed is going to be able to take more money out of the markets, and the stock market is going to be reacting to every single word Jerome Powell says. This is going to be a very, very interesting FOMC meeting, because what we're seeing in the market right now is a little bit of a rebound. This S&P 500 index was 405 yesterday on May 2nd. It was $5 away from touching the 300s, which we haven't seen, I think, in at least a year and a half. So it was 480 to begin the year, or to end 2021, which means we've seen a decent decline back to 405. But the question is, does it have to get lower given all the stuff that's happening right now with inflation, supply chains, and interest rates? Here's my ultimate take on this. I feel very bad for Jerome Powell because this is one of the hardest things that someone has ever had to do. I mean, imagine being able to control the world's freest economy and the decisions that you're making have a direct implication on what's going to get done. in one sense, I think the Fed wants to crash the market, not because they want to crash the market and be like, haha, we crashed the market, but because you don't want the S&P, for example, or the Nasdaq, let's take S&P at 405 to just go to 530. It seems like that's a little artificial. That doesn't make sense. That's kind of what happened back in 2020. Rather, I would think if I'm J Powell, I want the market to go down to 340 and then gradually come back up to 405 because that makes more sense. It's like a peaks and valleys of the market. You need things to happen in order for, to flush out some of the bad stuff that exists. Get rid of inflation, get supply chains back to normal, and then come back up. But you can't do that while things are bad. And that's what was happening in 2021. Valuations were going crazy, even though inflation was going up and supply chains were still bad. So it's like, why are we having these valuations? It didn't make sense. And even if you made money off of it, if it's artificial, one day it does come back to you. This has happened again and again throughout history. So the Fed has a really hard job here because they don't want to cause a recession. They don't want people to be super unemployed. They don't want massive, issues going on in the economy. They don't want another 2008 situation. They're trying to help the economy, but sometimes the best way to help the economy is to crash it a little bit in order for it to rebound. And this is the duality of economics that's so interesting to me to actually be able to understand a little bit more in depth. I think ultimately, we don't see a massive decline to the 380s, 30-40% decline from here to the point where we're in a real recession, because it seems like consumer demand is strong enough and inflation is starting to hit a peak. And if Jerome Powell signals these statements tomorrow, the market's really going to like it. The question is the market going to like it to the point where we rebound and we have an amazing rally? And is that rally even sustainable? Like if we get to 480 on the SPY, just like we were last year, is that sustainable? Did we do enough? Did the market go through enough turmoil for it to get there? It's been 6 months, or it's been 5 months since January. We've had the worst stock market in the first 5 months of a year in human history. If you're alive right now, you've experienced this, whether you care about the markets or you don't care about the markets. The question is, how low can it go, or how high can it get while still remaining logical? If it gets high without being logical, it seems like a bad situation. If it gets really low without actually, without caring for the fact that people are going to be in a bad situation if the economy crashes, because that's always bad for people, then that's also something that has to be taken into account. Maybe the best situation is just for everything to stay flat, is for inflation to come down, for stocks not to go up, for employment and all this stuff not to go crazy, for supply chains to get a little bit more back to normal, and to just stay flat for a while. Maybe that's the best situation, and maybe that's what the FOMC is going to be trying to do tomorrow in terms of what they're signaling, but we're going to hear a lot of their thoughts tomorrow and get a lot more comments and see where the market is going. What do you think? Do you think it's time for Jerome Powell to crash the economy? Do you think he wants to crash the economy? Or do you think we're actually going to be able to have a bit of a relief rally in stocks over time as things get better and hopefully as inflation goes down? I will be covering the FOMC meeting, so I'll be able to talk about that and everything that's going on. So videos will be on that tomorrow. Thank you guys so much for watching. I'll see you in the next one.